This is the future of finance.
This episode is brought to you by Metis Global Partners. Hey everyone, welcome to the Future of Finance podcast. I'm Georges Dyer, and we have another great one today for you with Jon Lukomnik, who is one of the creators of System-Level Investing, and who Forbes has called one of the pioneers of modern corporate governance. Jon is a longtime institutional investor. He's been an investment advisor or fiduciary for more than $100 billion in assets and has reviewed policies and procedures for asset owners and managers with aggregate assets under management of more than $1 trillion. In the 1990s, he led the New York City pension funds, and he talks about how that experience led him on a journey to understand how institutional investors could better serve their beneficiaries by not just beating the market, but helping to make the market stronger and to ensure the absolute returns actually needed to provide retirement benefits would be there. In 2021, Jon co-authored with Jim Hawley the book Moving Beyond Modern Portfolio Theory, Investing That Matters, which provides the academic finance theory behind system-level investing. He also co-authored What They Do With Your Money, How the Financial System Fails Us and How to Fix It, and The New Capitalists. He is the Brandmeier Fellow and Adjunct Professor at Columbia University's School of International and Public Affairs. And he's just a fascinating guy with a really unique set of perspectives. He's been a pioneer in helping to start this conversation around moving beyond modern portfolio theory, or MPT, as he refers to it in this show, and to help us just navigate these new realities and complexities of investing in the 21st century with this whole set of new and different systemic risks. So thanks for tuning in. Please like, follow, and share the show. I hope you enjoy this episode. And now here's Jon. Hey, Jon, how you doing? Welcome to the podcast.
Thanks so much. Thanks for inviting me, George.
Great to see you. I'm really excited to share your work with our listeners. But for those who don't know you, let's start with a little bit about your background and how you came to focus on this whole concept of system-level investing and write your book, Beyond Modern Portfolio Theory. And maybe, I think from what I understand, it really started with your work managing New York City's pension fund back in the 90s. Is that right?
Yeah, in the mid-90s, I was in charge of investing the 5 New York City pension funds. They're the fourth largest pension fund in the United States, 10th largest pool of institutional capital. At the time, they were around $80 billion. Now I think they're close to $300 billion. And it's a little crazy because there are actually 5 boards, and so you have 5 board meetings and 5 investment meetings a month, and it's very busy. But one day I had a couple of people cancel on me, and where my office was, I'm sitting looking out over the trading desk, and I realized that everything that I was doing was, and I apologize for cursing on your air, but bullshit. That it wasn't, we were doing good, valuable work. But what I really needed, instead of negotiating ISDAs and finding managers and seeking alpha and everything else, was some place to put $80 billion to earn a real rate of return above inflation forever. Because we were liability-driven investors. We have to offset pensions, much like endowments have to have a spending rule, or people save for retirement or to pay for college. The purpose of most investors is not to beat a benchmark. It is to offset real-world liabilities. And the problem is that modern portfolio theory provides no way to do that. It tells you how to extract the best possible return from the existing marketplace, but that's not always helpful. I'll give you an example. I'm trying to offset pension funds, the pension liabilities in the future. If the market is down 10 and I'm only down 7, I have done a phenomenal job. I've outperformed the market by 300 basis points. And if I'm a money manager, that's what my job is. But if I'm a pension fund manager, I only have 93 cents to offset my pension liabilities. On the other hand, if the market's up 10 and I'm only up 7, again, if I'm a money manager, asset manager, I've done a really bad job. I've underperformed the market by 300 basis points. But as a beneficial owner, as an asset owner, I now have $1.07 to offset my pension liabilities. And so in some ways, the idea of working to beat the benchmark was less important than what's my total return. So I started thinking about total return as opposed to relative return. And that was a 30-year journey.
Well, tell us a little bit about it. I want to get into your book, Moving Beyond Modern Portfolio Theory, Investing That Matters, that you wrote with Jim Hawley 7 or so years ago now, has it been?
No, it's actually only
Newer?
4. It
Okay.
feels like 7. They're dawn years. It came out in 2021. Actually, interestingly, a month away from you interviewed Bill Burkhardt on this podcast and Bill and Steve's book on 21st century investing. And the two of them, it was, I guess it was kismet that they came out close to each other, because in some ways, Jim and my book was the why of system-level investing. So here's the finance theory behind it. And their book was the how. Here are some tools you could use. So they worked well together.
Gotcha. So what happened in that interim after leaving New York pension and before writing the book? How did you sort of build this body of knowledge?
Oh, God. Well, I've actually written a number of books. I wrote a book that sort of heralded the corporate governance revolution, called the New Capitalist, with Stephen Davis and David Watson. We followed that up with What They Do with Your Money, which talked about some of the ways that the financial system is not fit for purpose. Some of the ways it is, some of the ways it's not. But it really started, I guess the entire journey was, what's the purpose of the financial system? How well does it do? I have had a consulting career. I'm on the board of a mutual fund and a European one. I worked for a French bank for a while. So, just a long time institutional investor. And for the last few years, I've been teaching sustainable finance at Columbia.
Yeah, nice. Well, I want to get to that too, but let's talk about, this whole concept of beyond modern portfolio theory. Obviously, that's been a central idea in institutional investing for a long time now. But so maybe just for listeners who aren't familiar, explain what modern portfolio theory is on a basic level, and why maybe it's showing its age now.
Sure. Modern portfolio theory was invented by Harry Markowitz in 1952. And it's hard to think about this, but at the time, only 8% of the U.S. equity market, and similar numbers in other markets around the world, whether equity or fixed income, was institutionalized. Basically, people picked stocks, if you were investing in stocks, by looking at a newspaper stock table, writing away for the annual report, and picking an individual stock. There were, what Harry Markowitz said that was revolutionary and brilliant was diversification matters. Now, and it was taught in the past that the individual riskiness and return was stock by stock rather than blending them into a portfolio. So in effect, Harry Markowitz set the stage for the modern worlds of mutual funds, ETFs, hedge funds, index funds, any sort of prepackaged diversified product. And literally, we have gone from 8% being like that to somewhere around 90% being like that. Now, I have to say, diversification is not new, right? We actually traced it back to Miguel Cervantes in Don Quixote in 1519, saying, don't put all your eggs in one basket. And I'm sure if we did more research, we could have found earlier citations. But what Harry Markowitz did was give us the math to make it work. 3 major capital market assumptions, which were what's your expected return, your expected risk, and your expected correlation of those returns. Now, there are a couple of issues with this. Number one, in some ways, it's a little bit like saying, if you give me the elements of the future, I can tell you what the future are. No kidding. And so what people do is they default to past returns and past volatilities, and maybe they tweak them a little bit. But leaving aside all that, the bigger issue that gets to the system level investing one is Harry Markowitz assumed the overall return of the market is exogenous, what investors call beta, the generalized price level of the market, was exogenous. And that what you could do was pick and choose stocks and try to beat that beta, which one could equate to a benchmark like the S&P 500 or the ACWI or the Bloomberg aggregate or whatever. And finance professors took this to heart and said beta is always 1.0 because it's exogenous, so we should measure against it. Here's the problem. Other researchers, Brinson, Bauer, and Hood, various Ibbotson studies, suggest that beta, the generalized price of the market, actually determines 75 to 94% of your variability in return.
Mm-hmm.
And so what MPT does is give you a brilliant tool to extract the most efficient 6 to 25% of your return. And until, 10 years ago, that was unchallenged. And it was like, why should I bother focusing on beta if I can't do anything about it, if it's exogenous? But to quote someone else you've had on your podcast, Rick Alexander, the fact that beta was silent didn't mean it wasn't salient. It still was determining the vast majority of your return. And in fact, large institutional investors sort of understood this intuitively. They went out into you couldn't diversify it because what Markowitz's diversification was diversifying the idiosyncratic risk of General Motors versus Volkswagen, for instance. But it wasn't dealing with, is the market up? Is the market down? Why is the market up? Why is the market down? And so investors actually realized that they could diversify what's called systematic risk, which by definition is non-diversifiable risk in the capital markets. But they started thinking about what causes this. And clearly, we do affect it. Risk on, risk off markets are just investors piling in or piling out. So it's not exogenous, right? We're doing it. Index effects are an unintentional thing where inclusion in the index or exclusion in the index will result in something, and then the index itself tends to float up and away by itself in addition to the component parts. And so investors started saying, particularly post-global financial crisis, what is causing the overall market to do what it does? Some things are obvious. People talk about Fed rate cuts all the time. But some things people start thinking were like, climate risk is non-diversifiable. Income inequality affects the economic health of the country and what the GDP is. There are sectoral risks, such as in mining, there were tailing dam collapses and a bunch of bad decisions throughout. And in the global financial crisis, obviously, there was no escaping that. There's just poor underwriting standards against them. So what all those things have in common, though, is they're not in the capital markets. You can't diversify them on a Bloomberg Trading Journal.
And they'll affect your whole portfolio, right? You can't get away from it.
Or a broad swath of it or a sector.
Yep.
And so you have to go into the real world and do something. If you want to fix mining, you have to go talk to the mining companies. If you want to deal with climate change, you're going to have to decarbonize if you want it. And so what happened was there was an important intermediate step called universal ownership theory, which said if you are broadly diversified, most of your return is going to come from the broad market. And you shouldn't trade externalizing costs from one company to make that company's enterprise value more valuable if it's going to destroy value in the other 499 stocks you own. So investors were doing this. I mean, the series principles came after the XLVLTs. crashed into Glacier Bay in Alaska. And so environmental things were on the mind. Corporate governance is an attempt to put guardrails around how the system works. And in some ways, the book that you referenced, Moving Beyond Modern Portfolio Theory, was very easy to write because practice was leading theory. And so what Jim and I did, starting about 6 years before that, before the book came out, was go out and talk to investors and say, why are you spending money on this? I mean, you're committing resources to try to mitigate environmental risks or country risk in South Africa or Northern Ireland, or corporate governance risk, independent voting, and quality of audits, and a whole host of things. And investors aren't stupid; they don't spend resources and money for nothing. And so we heard terms like, well, these are contingent deferred risks that could blow up. Or, well, it just seems to us that if we can decrease country risk and get a country to re-rate, then all of our investments in that country go up, and that's a good thing. And so we started looking at it and realized that the systematic non-diversifiable risk in the capital markets that Markowitz had taken as exogenous was actually created by systemic risk, by which I mean risks to the environmental, social, or financial systems that therefore affect the economy or the capital markets. And so what you have to do is you have to go, and you can't diversify it, but you have to go in the capital markets, but you have to go into the real world and try to mitigate systemic risk. Impact investors had been trying to do this for a while, but they were often trying to do it out of a values point of view. The mainstream investors were doing it for value, to try and get markets to re-rate. The one thing they now agree on, and one reason why system-level investing seems to be accepted more quickly than a lot of other theories, is that systems in the real world are really important. Some people may want to do it for values. Other people may want to do it for value.
Yeah, but either way, it's impacting everybody. Like what really triggered this? You alluded to some of it. Was it just the size and scope of these investors? There were just more people like you sitting at big pension funds in the 90s, 2000s, sort of recognizing that the overall market performance was really what they needed to focus on? Or was it this universal ownership theory kind of coming into focus that got people thinking about this more? Or what sort of like triggered this line of thinking? Was it just an evolution?
Well, one thing that you learn is there's never a single trigger. And so I think Jim Hawley's work on universal ownership, he wrote a book about it called, I think it was called Fiduciary Capitalism in 2000, was important. The global financial crisis made people realize that the financial system was a risk as well as an opportunity. And all these things are opportunities as well as risks, which we should remember. And then I think there was a confluence of a number of us. I mentioned Bill Burkhardt and Steve Leidenberg, myself, Jim, Delilah Rothenberg at Pre-Distribution, Ellen Quigley at the University of Cambridge, who started thinking about what are the implications around universal ownership theory. And what happened, the step between universal ownership theory and system level was universal ownership theory recognized the issue. System level investing says, here's what you can do about it and why you should do something about it. I do think the two books coming out simultaneously was very helpful. I think there were some funds, PGGM, the Netherlands stands out, that were looking at it starting from the global financial crisis and had moved in this direction. And so we were able to crystallize a moment in time where people were saying, wait, why do we have to accept all this systemic risk that causes this non-diversifiable risk in the marketplace? we don't have to do that. We can go out and try to mitigate it in the real world and try and make some money while hopefully doing some good at the same time.
Yeah. And how do you get it? Do you have a sense of like how many are starting to think this way? Because it seems like most are still kind of focused on security selection and portfolio construction and modern portfolio theory. Is that true, or is it changing fast?
There's what, $200 trillion of professionally invested money in the world.
Mhm.
Having said that, I am in the midst of, with Bill Burkhardt, editing something called the System-Level Investing Handbook. And we have $5.5 trillion worth of contributors to it. I would guess that's a minority of the people who are doing it in one shape, way or another. Now, there's an evolution to system-level investing. There's systemic stewardship, for instance, people who were the Net Asset Owners, Net Zero Asset Owners Alliance, or Climate Action 100, or Climate, or the Church of England, and AP Fund, and have done a great job with the mining industry around extractive industries. So there's stewardship. Then there's all the way at the other side, places like PGDM that have totally rethought how to actually invest their assets so that they know everything they own. Most people don't know the 499th stock that they own. Boom. And have invested specifically to be what they call 3D, which is risk, return, impact, but basically it's the same as system level investing. And there are a bunch of tools in between, including trying to influence policy, building tools for other people, and field building. And the other thing that is happening is people are now investing more in areas that they can directly affect things, such as infrastructure and private equity. And that's proven to be a hotbed of climate opportunity investing. So I think there's a moment in time. I think the books provided rigor and academic basis. And I also think there's just a changed view of the world post-global financial crisis.
Mm-hmm. Mm-hmm. And so you've talked about the system level investing handbook that you're working on with Bill. Like how we've had Bill on the podcast, some of the others that you've mentioned that are working on this. But for those who still are not familiar with what system level investing is at a basic level, like how do you define it? You mentioned some of the attributes, but what's sort of the short definition you use?
System level investing is understanding that 75 to 94% of your return is going to be based on the overall return of the marketplace. And that therefore you have to care about the systems that keep the marketplace healthy. And you're trying at a minimum to not destroy those systems, and a maximum trying to make them more healthy. And so you are focusing on the long-term, or actually I shouldn't say that because it's short-term and long-term impacts of your investment program, from stewardship through security selection, and what the impact will be on the underlying financial, social, and environmental systems on which the capital markets rely.
Mm-hmm. Gotcha. In the book, you say we're all beta activists now, which is, I think, another way of saying like you've got to try to influence that beta in some ways.
Exactly. The idea that beta is the problem is, and it is a problem, is that beta is non differentiated. And so it's a little bit of a prisoner's dilemma. If I go out and I lobby for some sort of climate regulation, that is trying to keep the system healthy. But there's no direct evidence that what I have done benefits me versus someone else.
Yeah.
And so it is easy for people to have a tragedy of the commons occur. I think word is getting out that it's not that expensive to do. And that is very helpful, because a number of asset owners and even some asset managers, BNP Paribas, Legal & General, obviously the responsible investing community like Domini, and Boston Common and those places, but mainstream, even like Legal & General and BNP Paribas, are understanding that the small amount that they invest in keeping the systems healthy are almost like an insurance policy.
Mhm.
And in a self-interested world, they get paid on assets under management, right? They get paid an asset-based fee. And so guarding against a 10 or 20% decline in the marketplace, is it worth 5 basis points? Is it worth 1 basis point? Is it worth a 0.5%? I don't know the answer. That's going to depend on each individual asset manager's desired net margin and assets under management and a host of things. But they're starting to view it as this is being responsible for the beneficiary investors who are investing, and B, in a self-interested way, it's like having an insurance policy against the market decline. And so that is how we are overcoming the tragedy of the commons issue. In addition to being smart about things like collaborative engagement, which reduces any one individual entity's cost of that engagement.
Mm-hmm. Yeah, I want to talk a little bit more about that. But, you mentioned kind of practice as leading theory in this a little bit, and you just mentioned a couple of examples there. But are there some other examples of big institutional investors that you think are really doing this well? Good.
Oh, sure. I mean, you had University Pension Plan on the podcast. I think
Yep.
they have built their entire program around system level investing.
Mhm.
I note that for instance, their very first, I'm not sure if it was direct or co-invest in private equity, was around the electrification of railroads, for a very good reason. CalSTRS does some really good policy engagement, and they have been particularly good about explaining why they do what they do in financial terms to try to avoid being tripped up in the current political environment.
Mhm.
Uh, People's Pension Plan in the UK recently changed managers. They pulled $23 billion from a manager because they didn't think that manager was aligned with the long-term interests of their beneficiaries around these sort of systemic risk issues. So a lot of pension plans, some insurance companies, Nippon Life is taking steps in this direction. Um, Large institutional investors, I think, are, especially those have liabilities on the other side. So life insurance plans makes perfect sense. Pension plans make perfect sense. Um, Anyone who's tried to offset real world liabilities has started to understand that the total return is what they need
Mhm.
to pay off those liabilities, and that it's nice to beat a benchmark. And look, I'm not knocking alpha. 6 to 25% is still it's like when people say it's the tail of the dog. Yeah, the tail's still part of the dog, and the dog wouldn't do very well without a tail.
Yep.
So I'm not knocking seeking alpha. I'm just saying that you also have to pay attention to beta.
Yeah. Yeah. Great. And so you mentioned the collective efforts like Climate Action 100 Plus and how investors might collaborate to work together on some of these topics. Talk a little more about that, because I think a lot of investors say like, well, even if I'm a huge fund, I'm just one entity. What can I really do to influence the broader markets?
There's a great University of Cambridge study out. This is a couple of years old now from Elroy Dimson and Oswan Karakis. I've probably butchered his pronunciation of his name. I'm sorry. Um, that talks about the effectiveness of collaborative engagement.
Mhm.
Similarly, in fact, in the book, we have Jake Barnett and Patrick Puera from Westpath and Allianz, another insurance company,
Mhm.
talking about the engagement track of the Net Zero Asset Owners Alliance and how they have collaborated. And I think in terms of trying to engage policy and investment managers as well as companies. Um, just joining some of the groups, IEN or the Council of Institutional Investors, or even PRI, gives heft to those institutions as they engage people. Um, so it's actually a fairly. I'm not suggesting that people just sign up and don't do any work, but It's better than not signing up at all, and it's a fairly low resource way. What I will say, we also have in the book the former Corey Kleber, the former policy director for the SEC, talked about how to be an effective policy advocate. And so I will say, if you do that, if you just add your name, at least when there's a sign-on letter, don't just sign onto the letter. Write your own letter, even if it's the exact copy of the sign-on letter, because it's just much more effective when the SEC or Congress or whomever gets a copy that's signed by you personally, as opposed to 10 names added to a letter.
Yeah.
So
Those,
there are ways to do this that are very low cost and low resource.
yeah. This episode is made possible by Metis Global Partners, a global equity solutions provider managing over $5 billion. Metis offers both active and customized beta strategies for institutional investors. Through their guided beta product suite, Metis provides custom passive equity solutions to clients desiring sustainably aligned equity and real asset portfolios combined with a high-touch partnership. Founded in 2013 in San Diego, California, Metis serves a wide range of institutional clients, including foundations, endowments, nonprofit, university, public plan, corporate, and family office clients. To learn more, visit www.metisgp.com. That's metisgp.com, or email info@metisgp.com. Tell us a little more about that policy piece, because comes up a lot in system level investing, is like investors' role and influencing or advocating for policy that can reduce these systemic risks. How do you see, well, you just mentioned sign-on letters, like what other ways do you see investors actually doing that? And do you see many, going beyond just sort of like financial sector policy and advocating for strong climate policies or prices on carbons or things that are going to address that?
Well, I just got back from PRI in person, which was in Brazil, pre-con. 1,200 of my closest friends. Yeah, people are definitely advocating. Look, the Paris Accords would not have happened without the financial community being fully on board. The imperative is you have to tie it to financial returns. Investors are not omniscient. Investors don't have unlimited resources. Investors have to do things that relate to the financial markets. You could be a mission-driven investor to have a mission as well, but from the investing side, it is very helpful to say, look, we need this information truthfully to determine risks and opportunities, or we have mapped out what will happen. An example, climate. Norges Bank estimates that its climate would destroy, I think it was 19% of its value of its holdings. Ortec Financial looked at large British pension funds and estimated there could be a 30% hit to net asset value. So these things are really material and major. And when confronted with that, you can sit back and say, well, I believe in monoportfolio theory. It's exogenous. I can't do anything about it. Or understand that the context of the world is what determines the price level of the marketplace, and engage with the context of the world. And the context of the world is policy, it's behavior, it's scientific discoveries, it's technology. If your investment horizon is blinded to a trading terminal, you're sort of neglecting the wider world out there. And I will tell you that when you go into the wider world, your view changes. Your tools also change. Let me give you an analogy. I happen to like Impressionist paintings. Okay. When the Impressionists went out to paint outside the studio, they had to reformulate their paint. It wasn't designed to withstand temperature changes. They had to have it in tubes. It had previously been pig's bladders and open pitchers. Easels were pieces of furniture. There was no such thing as a box easel that was transportable. So the brush strokes changed. And so the traditional tools that people have used engagement, yes, but still do enterprise value engagement, but also think about for an individual company, but also think about protecting systems. Investment policy statements and investment belief statements, incredibly valuable to align your entire organization around things. Policy engagement. Yes, I still think the thing that people are most comfortable with is engaging around financial and disclosure things, but substantive policy matters too. And people engage on everything from fair taxation issues to environmental. What you choose to engage on is up to you. Different institutional investors have different resources, they're in different jurisdictions, they have different time frames, they have different funding statuses, they have different skill sets. I mentioned UPP. Barb's Van, the CEO of UPP, is one of the Denner climate people in Canada. She's clearly going to engage in policy, right? John Hitler, who's writing a chapter for us, went from Legal and General, one of the largest asset managers in the world, to Builder's Vision, a family office, and said, at Legal and General, I was dealing with sort of standard setting and situational engagement and trying to affect broad swaths of the market. At a smaller, more nimble family office, I'm trying to deal with catalytic capital.
Right.
So what you do will differ, but your horizon, much like an impressionist leaving the studio and going into the world and saying, oh my God, there's all these interplays of light and air on the things I'm painting. Your horizon of, oh my God, there are all these interplays of policy and economics and technology and science on these systems on which my world depends, changes when you get out from behind your trading channel.
Yeah, and that doesn't mean every investor has to try to tackle all of them, you're saying, but they can
No.
choose, and still have that.
Every investor does not have to try to tackle policy.
Yeah.
Well, it is an important lever. But again, I think you do what you are best suited for in terms of both inclination and resource.
Yeah. Kind of tangentially related to the policy piece, what do you make of the whole anti-ESG campaigns and the kind of attempts to politicize a lot of these conversations?
So the reason we're doing the handbook is because when about 3 years ago, system-level investing got attacked when it first became very popular. And it got attacked in 4 ways. The first was fiduciary responsibility. I think we've dealt with that. In fact, in this book that'll come out in April, we have 3 lawyers, Keith Johnson, Susan Gary, and Tiffany Reeves, talking about it. In most of the world, the Freshfields legal framework for impact holds. In the United States, it's a little more controversial, but basically fiduciary duty is determined by your process and how you've documented dealing with issues of loyalty and prudence. And if you're doing this to improve your return, you're pretty safe as long as you've documented it well. The second way we got attacked was from the left. You're not doing enough about climate change. This could never solve climate change on its own. And then from the right, which is, you shouldn't be dealing with climate change. It's a political issue. You shouldn't be dealing with income inequality. It's a political issue. And I think both those critiques, and this gets to your question about the ESG, make the mistake of looking at the issues first. And they're dealing with it as political issues. So they assume that you're dealing with it as a political issue, which is why I said you start from what are you trying to accomplish to increase total return? What are you trying to accomplish to make the system more resilient? What you then try to do is say, what's the transmission mechanism by which the system affects my investments? So income inequality, there's a host of literature around the fact that it decreases GDP, increases recessions, makes recessions longer and less resilient, and also decreases trust and increases tendencies towards autocracy and lack of democracy, which increases country risk. So to me, the ESG argument is a false, or is a very thin argument, because in effect, the critique is projecting how they view these issues onto what you're doing instead of looking at what you're doing, why you're doing it. Now, I said, why are we writing the book? The fourth critique I thought was valid. Investors are trained in MPT, in capital markets, and how to analyze stocks and bonds and other assets and securities and put them into a portfolio. We're not trained on how to go into the real world that affects systemic risk.
Right.
Right. I mean, it's not something investors are comfortable with.
Yeah.
And so how do you deal with that? You look for exemplars so that maybe the trail's already blazed and you don't have to bushwhack quite as hard. Now, as I said before, you have to adapt it to your individual circumstance. But reading how UPP created an investment office to think through these issues, or how Roger Irwin at Willis Towers Watson thinks about the data challenges, or those things, I think that is helpful. And so the one critique I would say about this is it's harder to trace a direct input, output, outcome.
Yep.
Because in system level thinking, you have feedback loops and complexities and dynamic issues. That doesn't mean it's wrong.
Mm-hmm.
And in fact, I think not doing it is wrong. And what I've always said is I'd rather be directionally correct on something that's complex than wrong on something that's easy.
Mhm.
Right.
Yeah. But I think,
But it is a fair criticism.
and I think you get to the heart of it. I was going to try to kind of dive into this a bit more. It's like almost that causality, or as you said, there's sort of like in these complex systems, there's often a couple of levels between an action and an outcome, and hard to sort of trace back benefit. So do you think there are ways, as we get just better tools, better systems, more research on this, that can help show that causality? Or is it this sort of the theory enough to show that like this is part of your fiduciary duty because you need these stable conditions for the markets as a whole?
Can I say both? I mean, I do think the reason people talk about climate change so much is that the data and the science is further advanced.
Mm-hmm.
It may also be a more existential crisis, but it's also because it is easier to trace. I think there are reasons to measure that go beyond the proof statement, like learning how to do things better.
Mm-hmm.
For yourself. So the causality, you have to accept outputs and outcomes that affect subsystems in some ways and individual projects. I'll give you an example. When I was running New York City's pension funds, we had, and I believe the city still has, a very good economically targeted affordable housing program. Mm-hmm. And we built or refinanced tens of thousands of units of housing. And ironically, it turned out to be our highest performing fixed income program. And the reason was because at that time, banks were still redlining. So you had irrational credit constraint on the borrowers. And anyone who knows anything about mortgages knows this thing called complexity. In effect, convexity. In effect, the borrowers have an implicit put. If rates go down, they refinance. So you don't have the same returns for as long. Mm-hmm. Well, if they're credit constrained and you're the only program in town, they don't get to do this. So we actually had mortgage programs that way outperformed any conventional mortgage program, even while providing affordable housing. Now, we could quantify in terms of output, the number of units, the number of families, the number of people.
Mm-hmm.
Could we directly relate that to the affordability of housing or income inequality? That's a huge other step.
Right.
And that's why I say there are some things you're just going to have to take intuitively. It's better to have more affordable housing than less affordable housing. Mm-hmm. But I can't say with a straight face that we reduced income inequality in New York by X%. That's just not a calculation I can make.
Yeah. I'm curious. I wonder if you have thoughts on this around, I mean, so much of sustainability and these conversations, I think, are rooted in systems thinking. And I think our educational system and lots of other factors have kind of like uh, educated us away from being systems thinkers for many years. And I think, there's moves back to that, hopefully, which I think will help investors and everybody understand these kind of complex systems better. And I'm just really curious with all the AI stuff, if that might be a pivotal moment in really helping people understand systems and some of that causality and make the case for some of these things a little more clearly.
It's a great question. Here's the thing about AI. It is a tool. It is not either a panacea or a solution in and of itself. And by definition, AI, at least the large language models that are pattern recognition and everything else, only can work on stuff that it has absorbed and read.
Mm-hmm.
Therefore, we're still going to need human beings to design the solutions, somehow get that information into the AI, whether it's through a book or a paper or direct input or whatever. And so I think what AI can do is help spread answers and tools more quickly and more efficiently. I don't think it can make up de novo tools without human input, at least not as of now.
Mm-hmm.
And so when something is good, it can be replicated more quickly. Unfortunately, of course, when something's bad, it can be replicated more quickly also.
Right.
But let's talk about the positives right now.
Yeah. It could be its own systemic risk on it in its own right as we
There's
watch
lots of investors, who are now looking at the governance of technology as a systemic risk. And it covers so many things from privacy to disinformation to unequal distribution. So,
Yeah, absolutely. We have got a whole new initiative kind of exploring that. And it's fascinating, a little scary, but again, there's a lot of hope on the positive side too. I'm curious, you mentioned some examples from asset owners as well as managers, and just, do you have a take on, is it the asset owners that are really going to be driving these conversations? Is it both? Or do you see one or the other kind of really leading on?
I do think that it has initially been asset owners that have driven the conversation. I do think there are asset managers who are getting parts of this. And the reason is pretty simple, because I started off by saying, if you have real world liabilities to offset, right?
Yeah.
Asset managers are one step further removed from those real world liabilities. Their beneficiaries beneficial investors may have real world liabilities to offset, but in general, they do not. They are still judged by replicating or beating a benchmark. I think as the thinking continues, some of the asset managers, as I said, are looking at some aspects of system level investing for the two reasons. One, as an insurance policy against their fees going down because they're asset based. And two, because they think it's the right thing to do for their beneficial owners, or the asset owners have asked them to.
Right. They have that mandate.
Yeah. So mandates, we were talking about tools before. Your investment mandates are important in terms of this. How are, if you're not asking your asset managers, if you're an asset owner, you're not asking your asset managers, how are you thinking about system level issues? You're probably not concerned yourself. If you are concerned and you're not asking that, it's the easiest question to ask. And in fact, as I mentioned, the ultimate was People's Pension Plan in the UK, which pulled $20 billion from an asset manager because they weren't thinking this way.
Yeah. And I think, you said, what are the low cost ways to push some of this forward? I think that's one of the best, most effective low cost ways for asset owners of any size, is to ask the question to their managers. And even relatively small asset owners, if enough of them ask really big asset managers, they'll start to listen.
Look, one of the best system level stewardship programs is WestPath, which is a church related investment. They have $23 billion. So not small, but not big. And they have consistently asked their asset managers, and they've resulted in some change for their asset managers in how they think about this.
Yeah, nice. We'll have to have them on too. Cool. Well, what about, so given that, do you have, you talked about lots of different things they could do. Is there one or two that you just wish all investors would do tomorrow to help move this forward?
Yeah, I'm a big believer in fundamentals. So I would love for all investors to sit and think about their investment belief statements, their investment beliefs. How do you think markets work? What do you think they're reliant on? What is the purpose of why you invest? Is it to beat a benchmark? Is it to offset liabilities? Over what time frame? Because I think that if you actually sit down and think almost like a blank piece of paper and you were an investment program designer as opposed to an investor, right? And what I mean by that is, Apple thinking about, let's redesign this. And you come up with something totally new that some people love, some people hate, but it's different, right? If you sit down and you say, why am I investing again? What's my beliefs about liquidity? What's my beliefs about how capital markets work? What's my belief about opportunities in the marketplace? And you really do a positive process of doing the investment belief statement. The process is actually more important than what you ultimately put down on paper, because the process will help align you from your top fiduciaries, whether that's a board of trustees, through your investment office. And it will also enable you to speak to your stakeholders, the members of your university or the beneficial owners of your pension policy or life insurance policy or whatever, with one voice and say, look, we've really thought about this. Here's what we think we need for markets to be healthy. And if markets are healthy, here's how it will affect you. That is powerful, as opposed to having a series of ad hoc answers as to why you involved with this issue or that issue.
Right. I love that. It reminds me where you started, of having those meetings canceled and kind of having that chance to step back and really think, like, what is the purpose of this? What do I really need to do here?
It's interesting. We are all dancing as fast as we can, that sometimes we forget why we're dancing.
Yeah. Yeah. Sometimes you got to slow down to speed up and look back at the purpose. So we're coming up on time, but I do want to talk a little bit about your role at Columbia too. Tell us a little bit about, your teaching role there and what you're seeing from students.
I teach Sustainable Investment 2, System-Level Investing. I actually co-teach with Bill Burkhart. And it's an interesting role because we're teaching at the School of International Public Affairs, which is a policy school. And so while some of the students understand capital markets, others are total policy people. And you sort of have to explain why capital markets are important in all this and why markets are important. And I sometimes have to say to people, look, if you really want to change the world, it's nice to be standing on top of a pile of money. It's a helpful tool. It's been, teaching has been a wonderful experience. I have loved mentoring the students. We have a number who are now in the field. We've been doing it for several years now.
What's the interest level like from students in general? Are there a lot of excitement around these ideas, or is it mixed? Skepticism?
I wish we had more students registering. It is an elective. It's an advanced elective. And as I said, they are policy students. I think if we were in the business school, it would be a different challenge. We'd have to explain policy.
Right. Yeah.
So it's interesting, but I've always found that those interdisciplinary aspects are most interesting. The other thing is, we're getting interest from other schools about this. Carolyn Flammer, who heads the Sustainable Investing Research Institute at Columbia, where I teach, and the course is part of CIRI, is in demand to speak all over the world because of the focus partially on system level investing. She also does some blended finance things. And we see courses, Dave, my co-author on the previous book, David Pip Watson, teaches with Ellen Quigley A Purpose of Investing at the Judge Business School at Cambridge. So we're seeing interest in this topic around the world. And as pleased as I am with what I think is the relative rapidity of adoption in the capital markets, the next stage is how quickly does academia adapt?
Yeah.
Because that is a longer term, bigger challenge. People have tenure. They have taught modern portfolio theory for 75 years.
Yeah.
Not the same people, but
maybe in some cases.
they got tenure at a very early age. And it takes a while.
Yeah.
But I think this handbook will help. The fact that moving beyond modern portfolio theory is in more than a dozen cited in more than a dozen courses and all sorts of academic papers is also helpful. So we view our role. I love teaching kids. They should say kids, they're masters. I love teaching the students. I love mentoring them. But another part of the role is being an advocate for system level investing, both with practitioners and with academics.
Yeah. Well, academia can be notoriously slow and, for good reason.
Ways it help, George. I mean, you do run a work. So,
Well, exactly.
Talk to any of your concerns.
We're helping to get the word out. I got the book right here. People should check it out. But I do think also, I think what's working in favor of this getting adopted more rapidly in academia is there's just a real need for it. And as you alluded to, like these conversations get stuck in silos and disciplines often. And sustainability, I think, has long recognized the need for systems thinking and transdisciplinary education across disciplines. But I do think, when I heard this after studying these issues for a long time, it got me very excited to just sort of to make that case, as you say, for the interest of these investors who have lots of capital, and the need for markets to perform well, and just how much of the overall performance is based in that beta, I think will click for a lot of people.
I know we're at time, but I just want to tell you one quick story. So I was a visiting professor at the Georges Business School in Cambridge in 2020, right before the pandemic. And we hosted a forum for junior faculty from around the world. And during one of the coffee breaks, I was talking about interdisciplinary because I think interdisciplinary is really important. I mean, we sort of froze the topics we had. The way we teach is from 18th century German gymnasia. And
right.
There's, for instance, Yale teaches American studies to try and cut across things. But by and large, we take, social sciences, hard sciences, math, English, whatever. And so we're talking to this junior faculty member from American University. He says, you sound like my dean. He always wants me to do interdisciplinary stuff. I said, so great. Are you going to do it? Because after all, deans encourage you. He says, no, because the dean doesn't sit on my tenure committee.
Yeah.
And if as a finance professor, I publish something in a management journal, the finance professors who sit on my tenure committee assume I couldn't get it published in the finance journal. And so I am trying to break there's a lot of barriers to adoption in academia as well.
Yeah.
I am an optimist. I think in the end, good economic theory, which I think this is, overcomes those barriers. But I do think that because of the way that things are shaped institutionally, there could be slower adoption in academia than there is in practice, which would not be the first time.
Yeah. No, it's a great point. Awesome. Well, Jon, thank you so much. I'd love to do a few little quick takes, come rapid fire questions before we wrap up here. So, talked a lot about your work. What do you like to do outside of your work?
I love to cook.
Oh yeah. Nice. All kinds of stuff, or do you have
all kinds of stuff? The problem with saying that is then if you say you're a good cook, it sounds really arrogant. But so I'll just say, like lately, I've been playing with a lot of sous vide recipes, and we're having 20 people over for Thanksgiving, and I'm actually looking forward to cooking.
Yeah.
So,
Nice. That's awesome. We'll have to stop by for dinner next time I'm in town.
music. I'm a music freak and music and theater, but music freak. I love listening to music, and it's on all day. I turned it off because I didn't think you needed a soundscape for your podcast.
Nice. All right. How about one law? If you could change one policy to help this whole movement around system level investing, what would that be?
I'll give you a category of them,
Mhm.
and it's neither left nor right. Your members and me, when I'm working as an institutional investor, have a fiduciary obligation to our beneficial owners. Would state legislators, left and right, and federal legislators please stop trying to usurp our fiduciary obligation by telling us what to invest in or not to invest in? And I will put in the same category Texas's you must invest in fossil fuels. With Oregon's you must divest from fossil fuels.
Mhm.
If you're going to tell us to be fiduciaries and do real analysis of what the risks and opportunities of the markets are, let us do it. Don't impose your political opinions on us.
Mhm. Couldn't agree more. Good one. And how about aside from your books that you mentioned and Bill's 21st Century Investing, any other resources, books, podcasts that you'd recommend to listeners?
Let me go outside of this area because
Yeah.
you have educated for you. There is a wonderful book that just came out by Sarah Stein Lubrano called Don't Talk About Politics,
Mm-hmm.
which Sarah's a PhD, and she talks about what actually convinces people to change their mind or to have an opinion, and why our methods of discussing politics seem so often to polarize rather than to inform. So I will go outside of our area and suggest that one.
I love it. I'll check it out. Awesome. And then how about your vision? I mean, this is sort of what you do, but what's your vision for the future of finance? What does it need to look like in 20 years?
I would be hopeful that finance and the economy would be more aligned with improving the world. And what I mean by that is we go from a state where finance is somewhat divorced from the real world, right? Economy, markets are the solution. And we didn't even get into any of the issues about why markets are somewhat imperfect and information asymmetry and friction and the whole host of things. Markets are really useful tools, and they have to be part of the solution. But markets have to be subservient to the greater good of the real world. They cannot have the real world be subservient to them. Mm-hmm. And sometimes we get that confused. And to be fair, I think sometimes when you're in the middle of it, it's not always obvious when we have it confused. It's sometimes only obvious in retrospect, but I would hope we could detect those times more quickly and reverse them more quickly.
Yeah. Awesome. And then you said you work with college students, but what kind of advice do you give them if they're interested in careers in this space?
Think broadly and fundamentally. You mentioned AI, so I will just mention that. Use AI. I think that I said some professors tend to anchor to the past. Saying not to use AI is like saying not to use a Google search or not to use a computer. They're going to be used. But if all you could do is AI, then you will be replaced not by AI, but by the person who can use AI better than you, right? And so think cross-functionally. What is the issue you're trying to solve? What tools can you bring to bear on it? And bring your own experiences as well as the book learning.
Mm-hmm. Awesome. Nice. Well, John, like you said, there's a ton we didn't cover, but I think we have to leave it there. Hopefully we can get you back on to keep these conversations going, and really appreciate your time and all the work you're doing on this.
Thanks so much for inviting me.
You bet. Take care.
Okay, bye.
This episode has been brought to you by Metis Global Partners. Thanks for tuning in for the Future of Finance podcast. We hope you found today's conversation insightful and inspiring. Don't forget to subscribe or follow us on your favorite podcast platform. And please take a moment to rate, review, or share the show. All of this really helps us to reach more people like you who care about creating a thriving and sustainable future. And it's a really easy way to have a big impact. So please do follow. A quick disclaimer, the content of this podcast is for informational purposes only and does not constitute investment advice. Investments and strategies discussed may not be suitable for all listeners. Please consult a financial, legal, tax, or accounting professional before making any investment decisions. References to managers and funds are for informational purposes only and should not be considered endorsements or investment solicitations. This podcast does not monitor fund performance or guarantee the accuracy of third-party materials or statements. This has been an episode of the Future of Finance podcast, exploring how finance can shape a vibrant and sustainable future. Thanks for listening, and we'll see you next time.